This conference will now be recorded.
Good afternoon, everyone, and welcome to Kensington's first Power 30 webinar. This one is on a spotlight on specialist lender funding. So thank you, everyone, for joining the call. The Power 30 webinars are a series that we're going to be doing on a regular basis, trying to focus on relevant topics for the mortgage industry. So a few points of housekeeping before we start, though. The call is being recorded, and we'll go onto social media, so I just wanted to make you aware of that. Secondly, please keep your phones on mute throughout. There is an ability to submit questions through the chat function on your screens, and we will also take call questions over the phone after we've been through the slides. So my name is Alex Maddox. I'm the Capital Markets Director here at Kensington. I'm going to talk for about 20 minutes around the funding stability and what's going on in the market. And then I'm going to hand over to Craig McKinlay, who many of you will know as our new Business Director, who's going to talk a little bit around the recent volumes that we've been achieving and our plans for the rest of the year ahead. We'll probably talk for about 20 minutes about through the presentation, and then we'll open up for questions for the final 10 minutes of this call. So with no further ado, I'm going to kick into the actual slides. So January and February saw some pretty dramatic headlines from the specialist mortgage lenders. There were 4 lenders that we've highlighted here that stopped lending. I've tried to highlight on the right-hand side some of the reasons that they gave for leaving the market, and which ones were overlapping. The points generally, or the quotes there are from the press, although I've actually gone into their actual press releases to try to give the reasons. So for Magellan, Secure Trust, and the AA, they all refer to mortgage rates reducing and increased competition in the market. I'm sure you're all aware of the number of new lenders that have come in over the last couple of years. Magellan and Secure Trust also highlighted the economic outlook and the uncertainty. It's difficult for any of us to be unaware of all the Brexit noise going on, and the potential that has for a more bearish economic outlook going forward. Magellan was the only one to sort of specifically talk about cost of funds increasing, but as you'll see from the presentation a bit later on, that's something that is common across the market. Fleet was slightly different because they didn't actually pull out of the market for good. It was just a temporary stop as they worked to get their new funding line in place. So this was really about funding available, but I think some of the reasons why their funding may have dried up is probably linked to the reasons that some of the other lenders actually pulled out of the market. So what I'm going to do is go through the next few slides and talk about each one of these points in turn. So on slide 4, what I've got here is a very stylized view of how a mortgage lender like us operates. So we can charge on the loans, and then we'll go into the market, either whether that's a retail market or the wholesale market for our cost of funds, and the difference between those two quite obviously is our gross margin. And as you can see, if the retail rate comes down or the cost of funds go up, it'll put our gross margin under pressure. If we're able to increase rates or our cost of funds go down, then it improves our gross margin, and that's sort of true for all mortgage lenders. Then I've just got a slight split on the right hand side there, which is how our gross margin splits into an expected loss, which is the amount that we expect to lose due to credit losses, which historically for the last 5-6 years has been very negligible for almost every lender in the market. And then what's left over is our expected profit margin. So as I said, this is a very stylized view of how a mortgage lender operates, but what I think there's some key points here which were referred to in the press releases from the lenders on the previous page, and I'm going to take each one of these in turn. So if I start with the retail mortgage rate, What I've got here is some data. Most of this is publicly available data, although it's quite difficult to find. It's typically buried in, UK Finance or Bank of England data set, so you can find it in their website. If you'd like any links to that information, please email us afterwards and we can tell you where to find it. So the first one, if I look at, is the sort of the solid light blue line on this chart, and that's the SVR rate. So what I've done is the change in these rates since January 2014. So this is not the absolute level of rates, it's just how they've changed. So the SVR rate, as you can see there, has been bouncing around the 0 point. So it's really not changed very much. The Bank of England base rate hasn't changed very much either, but really not an awful lot of pressure for lenders on SVR. I think there's probably more pressure for lenders in terms of the need for product switches and retention, and so fewer customers are probably going through to SVR. More interestingly are the other lines below. So the dotted lines are trends for 75 LTV mortgages, and the solid lines, the green and the dark blue, are for 95 LTV. So if we look at the dotted lines first, what you can see is really by the end of 2016, there'd been about a drop of about 1% in the rates charged for 75 LTV lending, and then for the 2-year fixed rate 75 LTV, which is that dotted black line, actually the rates have probably picked up a little bit since then, but really haven't moved an awful lot. Whereas if you look at the dotted purple line, you can see there that the 5-year has continued to drop and is almost 1.5% lower than where it was in 2014. The 95 LTV charts, which is the green and the dark blue, tell a slightly different story. There wasn't much in terms of margin. Well, there was about 1% margin compression through to early 2018, but really quite a significant drop. And I'll talk a bit more about this in the next couple of pages. But you can see there that really it was the 75 LTV has generally dropped less than the 95 LTV. So if I move through to the next slide, what I've got here is looking at a couple of measures of sort of risk appetite for lenders. So the blue line here is the difference that lenders charge for a 95 LTV versus a 75 LTV. So as you can see, back in January 14, it was over 2.5% difference. So if we say a normal 75 LTV rate would have been at 1.5%, that means that the 95 was over 4%, so a 2.5% difference between the two. And it broadly stayed in that range through to 2017. And you can then see that there was quite a significant drop in that rate differential from sort of November 2017 or even sort of middle of 2017 to where it is now in January 19. So now there's just 1.5% differential between those two rates. And so what we're seeing is a significant step up in risk taking by lenders, and obviously great if you're a customer looking for a high LTV loan. You'll see the box there actually is with a TFS. So this is the term funding scheme that was offered by the Bank of England. This was announced after the Brexit referendum in mid-2016 and was the quantitative easing that was provided in the form of very cheap funding to all of the banks, effectively zero cost of funds funding. That finished 2 years later in the middle of 2018. But you can see how actually it's almost strange that you would have thought during the quantitative easing you would have seen a reduction in the difference in rate, but it actually really started to move at the end of the TFS scheme. The other one I've got there, another risk measure, is the difference between a 5-year rate and a 2-year rate. So this is actually the 75 LTV products, and what I'm looking at here is how much do lenders charge for providing a longer dated fixed. So this started off about 1% as a rate differential in Jan 14 and has dropped to about 0.3%. So what you've got here is two examples, I think, of great outcome for customers because higher LTVs are cheaper and longer dated fixed are cheaper, but ultimately some of these areas are not nearly as profitable as they used to be for the lenders. So now I'm going to switch over a little bit to talk about the cost of funds part of the balance sheet. So this is, the liability side, and I'm going to cover both the retail cost of funds, which is what most of the banks are exposed to, and also the wholesale cost of funds for lenders like ourselves who don't have a banking license. And if we go back to the list at the start, Magellan and Fleet are wholesale funded, and Secure Trust and AA were backed by retail funded activity. So similar kind of chart here again as you saw for the mortgage side, but this time we're looking at the liability side. So this is Bank of England data on deposits. The green line is short-term deposits, so less than 2 years. So they started off at about 2.25% back in Jan 14, and then now down to about 1%. So obviously not quite so good for customers who are savers, and there's also been quite a lot of press coverage on, on this kind of thing. But savers have definitely got a much worse outcome now than they had previously. The blue line is for longer term fixed deposits, so very much what you'll get sort of online, and you can see here that they started off at about 2.5%, just under 2.5% as well, and dropped perhaps more slowly than the short-term deposits, crossed over or became the same rate in late 2016, but really there's been a marked difference in rates for those longer term deposits since that point. It's strange because that was the period when there was the quantitative easing, but as you can see here, the average long-term deposit rate went up from about 1.25% to just under 2%. So really for banks that look to balance their funding with some short-term deposits and some long-term deposits, the longer-term deposits have got a lot more expensive. If I move through to some specific examples here, and I think it's always useful to look at specific lenders and how their rates have changed rather than just the averages from people like the Bank of England. We can see on the right hand side here what's been going on. So if we perhaps look at the top right hand table first, please, you'll see there Aldermore. No particular reason that they're first other than they start with an A. So in January 2017, their 2-year fixed deposit was at 1.2% or 120 basis points. This data is from Moneyfacts. And as recently as Jan 19, that had increased to 195 basis points. So a significant, what was that, over 50% increase in their cost of funds. And you can see for the other sort of challenger banks like Paragon or Charter Court, which you'll all know as Precise Mortgages, similar kind of moves. Charter Court and Paragon started off at a slightly higher rate, but have also ended up higher. So they're all around sort of 2.25% right now, and it's been a fairly steady drift higher for most of them, although Paragon seemed to move earlier than the others. For perhaps a larger challenger bank, Clydesdale, you can see there that they've also been impacted. So their cost of funds has gone from 70 to 160 basis points, and even the high street, Barclays and HSBC have had some impact here, although slightly less, with Barclays moving from 0.8 to 0.9. So I guess the message here is for these longer dated fixed rate deposits, it's been very competitive, and that's what you can see in that bottom left hand chart on the page there. We also included there the swap rate. It's in green on the chart. The swap rate is kind of a measure of the risk-free rate, and so that has been coming up, and that's been really pushing up a number of market rates. And the reason the swap rate is going up is because people think that interest rates are more likely than they were in the past. I must admit, my own personal view is, with everything going on around Brexit, that may not be the case, but that's certainly what the market thinks. If we look at the bottom right hand table, what we've got there is we've got the sort of the instant access deposits, and again a similar story for all of the challenger banks. So between 0.5 and 0.75% was where their deposits were for overnight in January 17, and 2 years later they're having to pay 1.3% pretty much, and here you can see quite a step up as well for the mainstream and the larger specialists, the larger challenger banks like Clydesdale. One other thing to mention here, which I think is pretty important, there's a new online deposit taker on the street called Marcus. You may well have heard of this particular brand. It's sort of designed to be very quick to access. You can go through the process in a matter of minutes. It's backed by Goldman Sachs, and it's their first foray really into the retail banking sector. And they're offering a mighty 1.5% for overnight access accounts. And I think, really this has been some of the reason why the challenger banks have had to put up their rates. And given that the Marcus proposition in terms of customer experience is excellent and better than the challenger banks, you'd also guess that some of those challenger banks are going to have to ultimately offer a higher rate than for Marcus, just because their proposition is not quite as strong. And particularly for the longer dated fixed rate, these customers are putting less than the government guaranteed amount of 75,000 into these accounts. So the consumers don't really care who the lender is. They just care whether it's easy to do and whether they can get a good rate. So I guess the takeaway from this slide, on slide 9, is that the rates are going up for everybody, and probably going to continue to go up even further with the likes of Marcus coming in and shaking the market up. So the next slide I'm going to talk about here is on wholesale funding. So what happens either for likes of ourselves, we only go into the wholesale market, but also some of the challenger banks and others will go into the wholesale market when the retail market gets expensive. And you can see here, this is the spread over LIBOR for our securitizations, the AAA senior class. And you can see that the TFS had quite a big impact on this. So what the market realized was there'll be very little issuance because everyone would take the central bank's money, and spreads dropped quite considerably during TFS, but then have raised really rapidly after the TFS came to play. And I guess the key message here is, so even if your retail deposits were getting expensive, your wholesale cost of funds was going up as much. So there wasn't a sort of a stress relief valve for the lenders here. So taking this through to, I guess, what's the impact of this on margin? So let's say the margin here being the difference between what we can charge on the mortgages and our cost of funds. What I've looked at here is that difference. So the gross margin blue line on 75 LTV, what that is just, you see pretty much zero since 2014. So the message is that for the average mortgage and the average funding, 75 LTV lending has never really been profitable. Maybe if you've got current accounts, it makes sense, and it probably explains why some of the current account funded banks are the main players in that space. But the gross margin on the higher LTV was great. It was about 3%, but that's been eroded pretty aggressively over that period. And so it's very difficult for lenders to subsidize their lower LTV lending through the profit margin on some of the higher risk. And I think that's really what you saw in the comments from Secure Trust and Magellan, is that this measure, how much you can earn on some of these riskier segments, and this is just one example of a risk dimension, is been dropping off quite considerably. And then obviously we can't forget the fact that the economic outlook in terms of our expected loss has also worsened over this period, something mentioned by Magellan. This is the GfK Consumer Confidence Index, but we're all seeing it in house prices, and I think you'd be a brave person to forecast an improved economic environment over the next 12 or 24 months. So not even this is there to support lower gross margins because of lower expected losses. So that's kind of the market backdrop, which is it's obviously a tough story for lenders as rates have come down on the loans and deposit costs have gone up. Talking a little bit about what we've done, we saw a lot of this coming our way in sort of the middle of last year, and we could see the changes in deposits, and also Brexit was pretty clear from that point. So we increased our warehouse line. We did that recently from 900 million to 1.3 billion. We actually did a lot of securitization in the end of last year, and it looked pretty expensive at the time, but with hindsight, it's looking pretty cheap. We actually went into the market recently. There was a window of Brexit, in the middle of the Brexit news a few weeks back, and we actually went to try to raise 400 million pounds, and we were offered nearly £1 billion, or just over £1 billion actually, of funding, and we took just about 540 million of funding. So we're quite fortunate that we are very well funded in the current environment. So with that, I'll hand over to Craig, who can talk a little bit about the lending side of the balance sheet.
Thanks, Alex, and good afternoon, everybody. As Alex said, we're in a pretty good position. We've got more funding than we've ever had, so very keen to get that out to the market. It was our year end last week, so we work to an end of March financial year. So these numbers are hot off the press, but we had a very successful year. So in the previous financial year, we did £925 million worth of completions, and we've just closed our year and we did 1.2 billion. So big improvement for us, 29% year-on-year growth, which is great because we've grown. You can see in the chart on the right-hand side, we've grown consistently over the last few years at about 25% compound growth. So we've continued that again. I'm told you guys will know better than us because you get a better view of what our competitors are up to, but I'm told that makes us the fastest growing specialist in the market of the big specialists. So we've had a very successful year, so thank you all very much for that, because it's down to your help and support we've done that. So very pleased with that, thank you. And we've also got we're about 25% of the specialist residential market share, which you can see the top right chart. That's taken from 27 Tech, so that's mortgage illustrations from last week, which so it's pretty up to date, and you can see we were about 23%, and you can see how we categorize the specialist residential market there with the different lenders that we consider our peer groups. So we monitor that every week, and for buy to let we oscillate, but we're often around the 10% market share mark. So yeah, we've had a very good year, so thank you for that. And if we look at some of the key things we've tried to do strategically, we've really invested in growth over the last year. So very keen, as you'll be aware, that most lenders, including ourselves at times, very happy to get the sales in, but then potentially don't have the capacity in the back office to support that. So what we've done is we've front run that. So we've doubled the amount of underwriters we've got in the team over the last year, and we've increased our customer service in terms of the BDU. So I think probably the thing we're most proud of last year is we had record-breaking sales, but at the same time as we had great sales, we also had great service. And actually during a period where sales went up and up, we held our front time scales pretty much universally for 9 months. So we were always within 2-day turnaround, 1-day valuations, 1 day to look at a case, etc. And we held that all the way through the peak of last year, which is fantastic. And we've also recently had a real focus on time to offer. So time to offer has been as low as 13 days. We're averaging about 15 days at the moment. But again, that is a massive improvement from where we were previously. And that's been in a time where we've grown sales significantly. So I think investing in underwriting capacity before we get the sales has worked really well. We've also invested in the sales team, so we've enlarged the sales team. So we've got 11 ASMs, you'll know them better as BDMs, across the UK and now into Scotland since we launched last year. So we've got more people on the phones, we've got more people in the field. We've got a new head of national accounts, who some of you will know, and we've got a new national accounts team. So we are starting our financial year in a really good position, and hopefully we've got the funding, we've got the service, and we've got the proposition to service that as well and offer you the best service we can. We've also really invested in data analytics and transforming our front and back offices. So some of you will have seen we'll be the first specialist lender live with 27 Tech mortgage apply in the next few weeks. We've invested a lot in analytics and data. So now all our field sales guys are all presenting off iPads. We've got Power BI. We've got really kind of deep analytics so that when we go and talk to your brokers, rather than just kind of pushing product and telling them what we can do, we're actually working with them to analyze their business, to look for opportunities so we can do some consultative selling, but also to help them understand their businesses better and where they have opportunities, even if it doesn't come to us. If we can help them, their businesses perform better, then that doesn't just help us, it helps the whole market. So big focus on transformation. We're only really at the start of that journey. There's so much we can do over the next 18 months, and we've got some pretty big news on that in the next few months that we'll be able to share. And then finally, the product innovation. So we really broadened our product and proposition set yesterday, over the last year. So yesterday we did have some launches. So we launched our Property Plus range, and we also reduced our buy-to-let range significantly. So we're now very competitive on sourcing. But over the last year, we've moved into new sectors. We've tried to look at later life segments, which is obviously a big area of the market and a big demographic trend. But we've also looked at the other segments, at the younger range. So we've got a young professionals range where we've got market leading affordability for young professionals. Limited company buy to let. We were probably a bit late to the party with that, but we didn't want to just launch a very typical limited company buy-to-let product. We wanted to do something different and innovative, which we've done with our unique way of approaching portfolio landlords and underwriting those for limited company buy-to-lets. We've extended our credit slightly, so we've got some very light adverse in options range, and we've also increased our LTVs, so we're 95% on residential and 85% on buy-to-let. So we're very focused on helping make sure we can help as many of your customers as possible, and hopefully being the first port of call after the high street. So that concludes the presentation. So hopefully that's given you a good understanding of what's going on in the market and what's happening with specialist funding and our funding and what we're trying to do as a business. What we'll do is we'll open it up for calls. So if you want to, you can type in a question to on the webinar, and also we'll open it up for verbal calls. So we'll just do that first, see if anyone's got any calls on the line. So I'm not sure if we've got any calls on the line currently. A couple of calls that we were previously submitted. So we had a question which I'll pass over to Alex for, about what does all these changes in securitization and all the market changes and funding, etc., mean for the future of mortgage rates?
Thanks, Craig. Yeah, so thank you for submitting this question. I think the outlook for mortgage rates, I think, is got to be that they're expected to go up. I mean, unless lenders continue to, support the market by reducing their profit margins, or cost of funds goes down, then they're going to have to put rates up. And on balance, we've seen probably more price increases recently than we've seen price reductions, and that's a bit of a change from the last 6 months. I think one thing that what could change this outlook for mortgage rates, I'm not sure we want to all vote for it, but a further round of quantitative easing from the central bank, probably linked to something like a hard Brexit. I mean, they came in with pretty aggressive quantitative easing just from a referendum, so you'd have to guess that for a hard Brexit scenario they do something similar or even more in order to sort of restore confidence in the UK banking system. In that case, you'd probably see cost of funds coming down significantly, and it would mean the rates in mortgages wouldn't have to go up. Having said that, I think the economic outlook would also be pretty tough, so lenders might be a little bit nervous about dropping rates on mortgages because of that. So I guess in summary, might be higher rates in the future if I had to pick. Are there any other questions on the line? For any of you who've got you're still on mute, please remember to unmute before you ask your question. Okay, well, thank you very much, everyone, for your time today. I hope that was useful. If you have any further questions which you'd like to submit in to us, you can please speak to anyone in the sales team or email us. And as I say, we will be doing further webinars in the future, so please look out for those. Thank you very much, everyone, for joining us.
Thanks very much.